can take that further, right? So, necessity. You can't just look at a high time. You can't just look at one chart. Not if you're trying to trade on a level that requires some invalidation below. Third, trade management. This is a very simple one, and I think it gets overlooked. So, managing your trades while you're in them. And here's 2 examples. And these are system ideas. Anyone who keeps asking me about system ideas, there you go. There's 2 free system ideas. Try those out. So, long a daily breakout and trail stops and exit based on a 1 hour over-under. Now, I think, if I'm correct, it's 4 hour, yes. Should be 4 hour. Same thing, right? Long a daily breakout. What is that? There's a daily breakout. Okay? So, looking here, daily breakout, and, you get long. So you get long on that close. And then you're waiting to exit based upon a 4 hour chart, not a daily chart, because you're trying to find an earlier exit signal, right? The idea being that if you get into a trade from a higher time frame signal, you can get out of the trade sooner by using a lower time frame reversal sign. The lower time frames build into the higher time frames, so the lower time frame is always going to signal first. Before you have a daily breakdown, you're always going to have a 4 hour chart that's showing weakness. It's not possible for it not to do that. The lower time frames build into the higher ones. Now, the flip side of that means the lower time frame is not always going to tell you what's going to happen next, because you can have 4 hour chart weakness within a daily strong structure. That is true. But looking here at a 4 hour over-under retest specifically. And so it goes all the way up to here. It sets a high. It sweeps the high. It breaks below. So there's your MSB. And you exit on the retest. That's an example of just the under-over using the over-under, I should say. Using this, it goes above, comes below, and you exit the retest. It's the retest of the market structure break. Which for particularly weak charts, or if you're kind of taking it the safest way, that's the best way to use the over-under in the context of if you think this might be a reversal, because of course you can't always guarantee it's going to come right back up there. The first time it retests that MSB, that's where the first place it could reject from. So using that as an example, even though this chart actually goes higher, I wanted to be fair on it and say, no, if I was actually trading this with this method and we saw that sweep and a strong breakdown and a retest of that level, I'd be out there. And that gets you out of a daily trade at a decent spot. Good risk reward. Solid, right? The idea, of course, is just that you're using the 4 hour structure to do that. Also, yes, I almost forgot. Trail your stops. Right. Now, don't use a trailing stop. I think trailing stops are bullshit. They're arbitrary. Don't place a trailing stop below price randomly. But you can use the 4 hour structure as your invalidation. So you can use it for where you're looking at trailing price. Initially, first of all, you want to use the daily, right? So if you're using the daily and it keeps making new highs like this, goes higher, and then it sets a new low and goes higher and sets a new low, that's fine. If your initial stop loss goes here, you can be moving it up and moving it up and moving it up as these levels come. As it comes down and doesn't break the lows, doesn't break the lows, doesn't break the lows, and it makes a new high, you can be trailing it up. Then, when you start to get into some of these parabolic phases, right, where you see just straight up daily candles with no pullbacks, you can then be using your lower time frame, which you're waiting for your trigger on, and using it like this. You could be using it there as this breaks out, and there as this breaks out, and here as this breaks out. And of course, that one might stop you out before that eventual signal is met. But you can use both. You can combine them. It's just another idea. You can trail. What am I doing here? Why is it not? Anyway, there we go. Reverse. There we go. Second one, long a daily EMA crossover, exit the next bounce based on a H12 cross. This is another good one. This is really simple. If you're using something like the bands for trade management, you want to enter on your higher time frame signal. So there's your daily, right? So you're entering because the daily bands go green. Super simple, right? But your exit, you want to exit when the 12-hour bands cross, not the daily, and I'll show why. but you don't exit exactly when the 12-hour bands cross themselves. So if I go back here and we look at this playing on, you can see it playing on a daily on the left-hand side and a 12-hour on the right-hand side. The idea being you drop down one time frame and that the 12-hour is going to show you the early sign of weakness so that you can wait for the 12-hour to be bearish and then exit on the bounce. I'll play this through so you know what I mean. Right, let's wait for the 12-hour to go red. It goes red here. Right, after this close. So if you were to exit just based on that, you would be exiting at 63, but you're significantly off the highs. That's suboptimal. Why? Because when you go up to your main time frame, you'll notice what? The bands are still green. We're still in a daily uptrend based on the bands. So there's a high probability that this is going to bounce, and you do have your weakness trigger from the 12-hour. You don't have to action it right away because your high time frame is still fine. Remember, you get in because they're green. They're not red yet. There's no reason to get out on the daily. Your 12-hour is giving you an early warning sign. And so there's a couple of ways you can do this. You can just exit at the retest of the bands. So basically, as soon as it bounces back up into the bands, you can exit, just like that, right? Because, look at, the daily bands continue to hold. Now, why would you even do this? Like, what's the point? Why not just wait for the daily bands to turn red? Well, any of you who've traded using double time frames, you'll know, quite often by the time the actual cross happens, it's too late to get out. And you have to take the hit. So even though it goes slightly higher, the 12-hour tells you there's trend weakness first. The daily is still green here. Still green, still green, still green. By the time the daily band crosses over here, right, it would be at 64. And you can't wait around for a bounce when your main trigger goes. This is the important part. If your main trigger, the reason to get in is green, your reason to get out can't be, oh, it's red, I'm just going to wait. That makes no sense. If it goes red on the daily, you are out. That's it. You can't wait around for a cross. You can't wait around for a bounce. If it's happened, it's over. You're out. So you don't get a chance to get out. And even if you did, you're exiting at 64 instead of potentially 67. So it allows you to eke a little bit more out of your trade by using the multiple time frames. Because then what you see is down it goes, right? And you never get the chance to get back out of that trade until, later on. And probably a best example of this if you're looking at something like the daily. And this is good for high times, it's good for low time frames as well. But it's like this is what you're trying to avoid, right? If you're trying to get too smart on your daily chart, in fact, if I actually look at the 12-hour here, this is probably a good example as well. If I use both, let me see. No, hold on. All charts, there we go. And they're at the same place here. So we look at the daily over here. All right, here we go. And we've got the 12-hour open. So we play them along, and you'll see this. Turns out this actually would have been a better example because it shows the thing you're trying to avoid here. So there you go. No, it didn't. False signal. Right, let's see. 12-hour. There you go. So your 12-hour gives you an early warning sign whenever the daily chart is still green, and you're able to see your bounce, and you could exit, on the next rally, the next retest, whatever. I don't think it comes all the way back up. Point being, your 12-hour gives you an early exit signal. It's up to you to figure out the exact execution of it. And the daily doesn't, because when the daily goes, in this instance, it's gone. So by the time the daily goes red, it's done. And you never get any bounce on any time frame that's of note, right? And you're out, and you're done, and that's it. And it goes down only, and there was never a chance. That's really what you're trying to avoid with these, especially if you're using something like the daily bands. Because when you just look at the chart, it doesn't cross green and red that often. Quite often, when it crosses green or red, that is the start or end of a significant trend. There are obviously exceptions, but there are times when it just trends and trends and trends, and that's it. You don't get an opportunity to go the opposite way. So what you're trying to do with lower time frame, on top of the higher time frame, is to get a better exit. Define your risk better, early invalidation. Next, contextual analysis. This is simple. This is what everyone should do. But Can be difficult. It's about keeping a zoomed out perspective on trends and consolidation. So, what does that mean? Like this. High time frame context here. You're in a weekly uptrend. Okay, so the market's moving up, strong move, high impulse, weekly uptrend. So when it pulls back, the first thing that should be in your mind is looking for low time frame continuation signs. But what tends to happen is that this stuff here, the lower time frame chart, starts to send people in a spin, right? Because it doesn't look bullish here. And it's easy to forget that the weekly, the higher time frame, the stronger trend is bullish. So what you should be looking for are signs of reversal, signs of continuation. So after you've had the sell-off and it's all crashing down, it all looks like shit, start to be on the lookout for your lower time frame signals. Some things you spot here. A double bottom, which is this simple reversal. So we're in a weekly uptrend. We have a low time frame simple reversal. We then have a market structure break here, right? Where it's trending down, breaks higher, holds, tries to go lower, gets back above, and retests. So it breaks market structure, successfully retests, and is starting to move up. At this point, risk reward would say, and probabilistically you could say, this should be trending higher. This should be at least going towards the highs. Why? Because we're in a weekly uptrend and we have a low time frame reversal sign. That's your trigger to look for longs. I'm doing some of these on the high time frame, but low time frame is just as important. If you're in a 4-hour uptrend and you see a pullback on the 5-minute chart, ask yourself, what are the odds that this 5-minute chart pullback is the top? This is it. This is the end of this 4-hour trend. It's unlikely. And yet, whenever any chart pulls back on a low time frame, people forget the higher time frame context. That's the main thing. This is your contextual analysis. You're looking at the higher time frame. This also would help you, just as a side note, this also would help you with stuff like this, right? After everyone got so just blind by the bull market, many people missed the clearest weekly swing failure pattern, weekly breakdown, weekly structure break, weekly lower high bounce. This took 6 weeks, right, from start to finish. And by looking at that exact same weekly chart, this weekly chart would have you looking for longs, continuation. This weekly chart here, after that move, you should only be looking for shorts. High time frame context, very important. Speaking of which, what are we at? What is it like now? It's sort of in between. We have a weekly uptrend, absolutely, and we have kind of a sideways choppy correction. So if anything you're looking for, it should be areas to get long. Now, just like that 2021 move, this is completely off topic. Well, not on topic, but just like in 2021, where when it started to recover and started to rise up, you'll be expecting the next breakout to hold. The same thing does still apply here. Bitcoin has not broken any weekly structure. The only negative, of course, is that we took out the all-time high and fall back inside. That's absolutely the number one caveat to this, because Bitcoin did fail an all-time high breakout and fall back inside. But if you're looking in the context of this weekly uptrend, the expectation would be the next breakout, should it come, should hold and go higher. And that's why if and when we get above that 70k mark, that's when you should really be looking at it more like these moves here, that it should have continuation once it's able to actually get that next break. Now, that's the why. That's why you're doing it. The 4 different reasons, there's a little bit of how in there as well, but the 4 different reasons for using multi-time frame: tighter entries, define your trades, trade management, contextual analysis. All right. Now, how? How about the how? How do we do it? I've already shown a couple, but let's dig more into it. There's 3 different parts that I want to talk about here. One of them being the fractal approach. This is the simplest way to use multi-time frame trading, and would be probably the first thing I would recommend that people look at before you start trying to nail super tight entries and get fucking 60-to-1 risk reward, which is just bullshit anyway. Try not to just default straight into that. Fractal approach. If you're bearish on a weekly, look for further bearish signals on the daily. Look for further bearish signals on the 4-hour. using the same behavioral pattern. It's also known as double confirmation. Guess you could call it triple confirmation as well if you want to go insane with it. And that looks something like this. Fractal approach. Very simple, right? Let's say this is a 1 day chart, and then you go and you look at this on a 1 hour chart, and the idea being you see a 1 day reversal, which is in the form of an under over, and on the right shoulder retest, if you zoom that in, it looks like this, but on a 1 hour chart. So this 1 hour chart all happens within this red box. If that's confusing, don't worry, because I'm going to show you right now using a 4 hour and a 1 hour. And it's actually a very recent example. So here, 4 hour chart, we have a low, which is the left shoulder. We have a sweep, which is the head, if you're using the head and shoulder analogy. We have the market structure level, so the high that led to that lowest low. The market closes at the green arrow. The 4 hour candle closes above that level to confirm a market structure break. We then go back down for a retest, the right shoulder, and then we zoom in. So we zoom into the hourly, and what you're looking at here is how to actually enter. So you see it coming down into here, and at this point you're like, well, yeah, it could be a retest, but it could also be breaking down. So you wait, you do the exact same thing. You take your low here, you get your left shoulder, you get your market structure level, you wait for a break above, and that market structure break with this green arrow confirms your double confirmation. You can either enter there, or you can wait for a retest if you want it to go lower, and it does both. You enter there, you're correct, comes all the way back down. It actually does put in that protracted sort of right shoulder. Doesn't matter. With the double confirmation, for me, with the double confirmation, I'm just waiting for the shoulder, the head, and the break. That's all you need. Because now, you know where to get in. And don't forget, you're zoomed out. You're confirming this as the low. Right? You don't have to get along here and put your stop loss there, because it could come down and stop it out. The point is the 4 hour gets confirmed by that move, and when you have that extra entry there, you're now saying bottom's in, and you're into your trade. If you then want to use some of the other methods I mentioned before to compound it and tighten it up after, absolutely you can. Once it starts to break higher, what do? You move your stop up. Move your stop up in line with market structure. So, fractal approach. Double confirmation. By the way, if you have any questions on this, ask them in live questions, because there's so many other different ways to use multi-time frame that I'm interested to hear what you want to ask. Now, fucking getting a better entry after confirmation. So, first of all, you wait for a high time frame confirmation, and then you use a low time frame method to enter. This allows you to define your risk better and acts as a double confirmation. So what does this mean? When you see a candle close, I'll just use an example here before I go on to the main one. Let's just say, for example, this, right? Just look at today. Whenever this candle closed, a lot of people would be like, let's go, let's get long, right? And the very next day, you know this, right? You know the next day is unlikely to not have a lower wick. And so even though you bought on the close, you could have got an entry lower. Now, it's not always about trying to get the perfect entry lower. It's about actually waiting for a confirmation, which looks like this. I actually use ETH for this one. And we're looking at just a really simple breakout, right? So the breakout from this level above the dotted red line. And we're on a 4 hour chart, and you have a 4 hour close. So here, at this point, you've got a 4 hour close. The problem is, and I use this one for a reason, the problem is it's not really that strong of a candle. There's a bit of a wick on top of it. Like, would I be confident to just buy here and put my stop loss below that candle? Not really. This isn't like a big impulsive breakout that would give me confidence. So what do? I don't abandon it. ETH's going up. It's going up. It's consolidated. It's going up. It's breaking out. This should be continuing. So what you do is you look for your lower time frame. So you zoom it in. I don't know which time frame I want. Did I go 1 minute? Or 15 minute? I think it might have been a 15 minute. No, 1 minute. Yeah, this is one of the ones where you can go way in. Right, here we go. Let me see. Yes, using a 1 minute chart. Now, this is going to give some of you fucking headaches if you're not used to the 1 minute charts. It's probably more for the lower time frame traders. But your 4 hour close, which is actually also a daily close, but we're using the 4 hour here, was confirmed at this point, right? And remember, you've got a bit of a wick on the upside. It's dropped down. You're not certain. You're like, would you really want to long this? Would you want to long this after the close based on that? Even though it should be strong, what do? You wait. Candle opens. Wait for it to go down. It's going to put a lower wick in. And so the idea is, it goes down. It goes down. You mark your structure. There you have an MSB on the 1 minute. So you notice it goes down. It goes down. It breaks above. Then it goes. It's just really simple. It's just using that. And you could enter, obviously, right away. You could wait for this. You could even wait for that impulse candle. And now you have a low that it shouldn't go below. And you're able to define your risk better. The whole point of this is, you might look at it and say, technically you could enter there. But, I wouldn't begrudge anyone for waiting. If you wait for that and this impulse, absolutely no doubt. There's no doubt at this point that if this is a high impulse candle that's going to continue, that should be the low. And that means you can go like this and define your risk better. Because it might not look like much here, right? It might look like a really wide stop here, but when you zoom out, this gives you so much room. Right? You can barely even see it. In fact, I have to zoom in again to widen it out. It gives you such a better idea of your risk reward. Let me zoom out. There we go, right? So now you get a trade that looks something like this because you've waited. I'll take off this and I'll take off that. Because you've waited for the lower wick to get put in. You've waited for low time frame sign of reversal and impulse in the direction that you want to trade because it is a bullish breakout. You're just waiting for confirmation. And you define your risk. And instead of having to buy it here, just on the close and putting your stop loss down there, which will be a wider stop, you're able to do that. And that's the difference. Instead of a $54 SL, you get a 22 one. That allows you to use tighter risk, which allows you to be wrong more, right? If you have a tighter risk reward, you can actually afford to be wrong more often because when you're right, you're going to make more money, which is one of the most important things as a trader. Everyone obsesses about having super high win rates, but if you listen to top traders talking or explaining, a lot of them talk about this. Jesse Livermore did, all the guys in the Market Wizards did. I talk about it all the time. Probing the market or trying to get an entry. Yes, it would be beautiful if you could just nail the perfect entry at the perfect time and the market just goes straight up in your favor. That would be ideal, and sometimes that happens. More often than not, you might have to take 1 or 2 or 3 stabs at a trade. Especially one that is still valid, especially one that is still showing signs of being in a bullish or bearish setup. Don't restrict yourself into always thinking I have to be right first time. If you're able to define these better entries using multi-time frame, you can have a higher risk reward. So you can be wrong more and still make profitable returns. You can have plus EV. But please, test this. You have to test it. Replay a trade. Just run through the charts and replay trade them and say, what would I do here? Even not in a backtesting context. This is maybe a bit more advanced. If you're not a blue or purple belt, maybe just ignore this part. But if you've done a lot of backtesting in the past, you can also just run through the chart like this and replay trade it and say, how would I approach this? Okay, there's a breakout. What would I do? And zoom into a lower time frame and look at it and say, all right, where would I enter? I'm waiting for low time frame reversal, signs of strength, all that kind of stuff. Finally, early entry in a breakout. Most important high time frame levels get retested in low time frame first. So this is the right way of saying it. I guess highest risk is the only way of saying it. It's not actually high risk. Nothing in the market is high risk if you manage your risk, right? But when I say high risk, I mean you're going for the lowest time frame and the least amount of confirmation, because that gives you the highest probability of being early. And if you're early enough, you get a big enough move, it can make up for many, many losses. This is one of those, and I'll pre-warn you, if you're not someone who takes losses well, don't do this. Because you could very well have a 20% or 30% win rate using this kind of style. Because you're going to be wrong a lot. But when you're right, you're going to be right bigger. Okay? So, this is where you're actually entering into a breakout. So before it's confirmed. And there's an example here. I'll use the ETH one first. Right? So, how would you get into this daily breakout before the retest. Because what do people do? Most people don't look at the charts all day. They're not sitting on the fucking 1 minute chart like us insane degenerates. They would see, oh, ETH had a big move, big breakout, I guess I'll wait for the retest, right? And so what a lot of people do is they wait for the retest and they buy the retest. Of course, in this example, that's great. It comes back, perfect retest, but you know that's not guaranteed to happen either. Many times it would just go straight down through. And of course, you have to wait 6 days for something that may not come along. And then you have to wait for a double retest and wait all this, and it's a lot of opportunity cost. You buy that retest on the 14th of November, it doesn't break out till the 2nd of December. So if you're a lower time frame trader, that's not really ideal. How can you be in this candle? How can you actually be in that and trade that? So you go and you jump on, and we look at low time frame, and you can go as low as you want, but I think a 5 minute chart shows this one, if I'm correct. And you're looking at a breakout from, yeah, here we go. So what you're looking at here is that exact same daily breakout level, which is the dotted line. The dotted line is the daily breakout. And so it tries early in the morning to break out. And it fails. So you don't buy blindly. Again, this is the important thing. You don't just buy because it's gone above that level. You're waiting for some kind of signal on a low time frame that it's going above. Right? Just keep it really simple. Market structure. It's going above the breakout point and then continuing to trend on a low time frame. If this is going to be a daily breakout, right? If you take this level here and you say, if this is going to be a daily breakout, what's it going to do on the 5 minute? On the 5 minute, it's going to break out and it's going to make a new high. And it's going to make a new high. And it's going to make it, right? It's going to make break a structure. And if you trade any one of those in between, not buying here on the first breakout because there's no confirmation, you could buy there, second breakout. You could be there, third one. And all of those will still give you a close entry towards that breakout to be in that daily move like this. So in this example, you have a breakout initially, then you have a failed break, then you have a retest, and it sells off. So there'll be no trigger to get long here. Then it does exactly what you want to see. It goes back below. And what does it do? It sweeps. You actually get it under over. But the part I'm most interested in here is it tries to go below, it then reverses on low time frames, and then here it starts to trend back towards the highs. And you could be getting long there, or you want to wait for confirmation with your BOS here. That's your double confirmation. That gets you an entry to get long. Now, all of that, if you're buying in there at this point, you're saying, I mean, even this is a very wide stop, relatively. You could actually use a tighter stop. But even using that wide stop, when you zoom it out, you look at this whole thing, this is the beginning of a bigger move, right? So when we zoom it out onto a daily, you can see how being inside of that, there you go. So you can be in the bottom to middle of that candle and catch the whole thing. Of course, selling it's a different matter. That's not the point of this. The point is just about entries. And that wasn't even with the most aggressive entry. You could enter much more aggressive, test it. Test super aggressive entries. You know, if you want to have higher win rate, higher risk reward, sure, but make sure it still stays plus EV. Also, on these better entries, this is the most aggressive style. This style really requires day trading because you're essentially taking a 1 week or a 1 day breakout. So you're taking a high time frame breakout and you're trying to trade it on a low time frame. You have to understand that many breakouts will fail. The exact same thing was probably done over here, right? And it failed. But did it? Not if you're taking profit. And here's the part that gets people fucked up. They just don't take profit. So what do I mean by that? When you look at that example I just showed, the temptation is to think, oh my God, I've nailed the bottom and I'm fucking just going to hold it. But if you nailed that on a low time frame here, remember, when that breakout happened and confirmed, what was the first thing I said? The higher time frame guys are going to wait for a retest. If you manage to catch the breakout, guess what? At some point, it's probably going to round trip all the way back to your entry and you're going to be pissed off and you might even close it. Don't be afraid to take profit, especially when it comes quickly. You're not trying to catch, please don't fall into this fucking trap of thinking that everything has to be a generational entry. It's fucking not. If you take profits, especially when your trade determines it, right? You're waiting for a sign of reversal. In fact, if you were entering on the 5 minute and you're watching this strong move go up, you're just looking at a sign for the market to show you to get out before it potentially reverses all the way back down, right? And you're looking at this and you're looking at the whole thing, and you could just even be waiting to there. I mean, at this point, I would say if the market starts to break below there, you want to be out of that 5 minute trade. If you got in there or whatever, you want to be out at that point. Here, you could probably still stay long, but you certainly don't want to be long there, right? When it starts to show this weakness, it's probably going to make its way back down eventually. And the point is, there's a million places to get out here. Look how much weakness it shows on the 5 minute, even by eyeballing it, before it eventually goes down. And how many more opportunities it gives you to fucking get out. And eventually it goes all the way down to where that retest point is. And you don't want to be the guy round tripping the whole thing, right? Also, the ones that fail, let me do this. This is just one that came into my mind here. Because you don't just want to look at stuff that only wins, right? But this one here would have a completely valid setup on a 1 minute or a 5 minute for this breakout, right? So the initial breakout here went higher. And you can see that if you're buying this, let's say it breaks out, retests and holds. You could have been buying there. Maybe it comes back down, maybe it stops out, comes back down in this area, holds again, rallies up, takes the highs. There's still long trades to be had there, even in this one, which ends up closing the day as a big bearish candle. At best, and what you should be aspiring to as well, by the way, at best with these ones, if you're trying to play these breakouts, you should be trying to get to a point where you're able to exit those trades at break even if they're wrong. If the weakness comes in, which would be defined by this, like if you're looking at that breakout where it came above this level, which is around there, I mean, I'd be looking at this right away and saying, that's fine, that's valid, comes back to here, I'll be out. Because that is not how, look at yesterday's breakout, for example. Take yesterday's breakout as an example of how it should move whenever it breaks above the level. And it was 62.8, wasn't it? 62.8 area, right? What happens when it comes up to that level? Almost the exact same setup here as here, right? What does it do? Let me zoom it in. In this one, the breakout goes above, retests. Goes above, retests. Very, very, very common. When you look at these breakouts that on a 4-hour chart or a daily chart it looks like it didn't retest, they almost always do on a low time frame. Go to a 1 minute. You will see retests. The difference here is what? It makes highs, comes back, makes highs, makes highs, makes highs, and continues. It should just continue if it's going to be a bullish impulse. So let's say you got long on this one here. At that point, by the time it comes up, it comes all the way back down and reverses the whole thing, you should probably be out. Right? You should probably be thinking about exiting. Especially when it does this. Even if you stayed in and it comes all the way back down, you should definitely be out. It's showing that it's not doing this up, 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 impulsive breakout type of price behavior. And the idea of that is try and develop early invalidation methods so that you can take a lot of low risk, not free. You will get some break-even stop outs or break-even closes, but try and lower it so that your invalidations are sooner. You will, if you take time with this, and this is only for the day traders, you will get better at identifying when a high time frame breakout is going to fail, and you should be able to cut your trades earlier, on average, not every time, to save yourself some dollars, because whenever you're right, you're going to be right big. The key with this, super important, this last part, the key with it is absolutely risk management and capital preservation. You want to make sure you're not pissing away your money trying to capture all these trades. This is not a style of trading where you just set it and forget it.